Hi, and welcome back to Retirement Investing Out Loud. I am your host, Bebop, and we're checking in on our investments today. It's going to be a short one today. I do want to talk just about a couple of things. Since we last got together, the market has done some wild things. It's reacted wildly to the political situation going on in the United States right now and the world. And especially yesterday, it reacted with a lot of volatility after the U.S. president turned his eye toward Greenland. So that's interesting. With that lack of stability, the markets tended to adjust. So what happened is crypto took a huge hit. People were not sure about risking their money, so they pulled it out of crypto and went for gold because gold topped off at over $4,700 an ounce now, record high. So people wanted to store their money in a safe place, and that's where they consider what they considered safe. For us, being long-term investors, these kind of ups and downs are to be expected. This kind of volatility is just part of the game. You can't avoid it. It's going to happen. But this particular portfolio is built to navigate that. It's built to kind of ride those bumps and waves. So one of the things that I've found with investing is that the lingo is very dense. There's a lot of shorthand. There's a lot of strange vocabulary when it comes to investing that most people aren't privy to. And especially investing journalism is rife with these. They almost act as gatekeepers to anybody investing on their own. And I think that's done particularly purposefully. I think it's done very purposefully. I think especially old guard investors don't want the people, or any people, to have any kind of agency over their investing. So they've created this very dense vocabulary and ideas that it's challenging to get through. So we're going to try and break through that just a little bit. Something you're going to encounter is a couple of terms: inflows and outflows. Now, inflows and outflows can mean different things depending on what you're talking about. When you're talking about investing directly into cryptocurrency, inflows are when cryptocurrency holders put their cryptocurrency into a market or on the market. It's basically in a position to sell. It signals that, and especially when you're talking about larger cryptocurrency holders, institutions, that kind of thing, when they put their cryptocurrency on the market, an inflow, it often signals that they are getting ready to sell. And that is something that can shock the market a little bit because they'll see a big holder. A lot of traders will see a big holder starting to putting inflows onto the market and signaling a sell, and they will start selling in order to reduce their losses or avoid losses. Conversely, outflows is when cryptocurrency holders take their coins off the market, when they put them back into their hard wallets or cold wallets, or stake them, which is a way of earning interest on your cryptocurrency, or accumulate. In other words, they'll buy up a lot of cryptocurrency at a certain price point. In fact, that is happening now. There are institution buyers and large buyers who, now that the price has slipped again, are starting to accumulate more because they're ready for that price to start going up. And when you see a lot of accumulation, that's kind of when you'll see that downturn kind of break, and start heading back up again. And I'm sure that's what we're going to experience over the next few days. So when you're talking about ETF investing, it's kind of the opposite. Inflows are capital investments, and outflows are when capital is pulled off the market. So it can get kind of confusing depending on what you're talking about. So you got to kind of zone in on the context and see what they're talking about. Now, inflows and outflows alone aren't the only determinant of what's going to happen in the market. They're certainly not a predictor, but it's just another little tool you have to look at something and kind of analyze it yourself. And it's something you're going to see a lot when you're looking at any kind of the journalism. And to be honest, when it comes around crypto, I use journalism very loosely because, man, some of these guys out there are just throwing out whatever. So, but it lets you read a little more critically and a little more well informed. So, without further ado, let's just take a real quick look at where we're at. Bama and I are looking at retiring in about 6 years, and when we start taking Social Security, we're looking at retiring abroad because we would like to save money on our living expenses and our health care for sure, because that's gotten just kind of completely out of hand in the United States. So we are looking at build. This is part of our investing to get there. And I got into this investing because I had never done it until I was over 50 years old. I finally started putting away money. So I'm trying to catch up a little bit and decided, hey, I've got to start pulling my own weight on my end. So what we got here, we've got some cryptocurrency holdings. Now our cryptocurrency holdings, like I said, took a big hit the last couple of days. So we are almost $100 in the red. And that's part of the ups and downs. We're playing the long game. I keep saying it, and it like a broken record, but it's true. We're playing the long game, so we are going to experience dips like this. And I look at it this way: it's a chance if this stays low like this, it's a chance for me to invest and accumulate a little more cryptocurrency when I do my $100 investment, right? Now, dividend ETFs, actually, they took a dip yesterday, but they don't have the same volatility cryptocurrency does, and honestly, they don't experience the deep volatility like that the S&P and the Dow did yesterday. It took a little hit yesterday, but it bounced back beautifully today. So right now, we're sitting on $11.43 of total gains, or net gains, and that's great. That's operating exactly the way we want it to. Those dividend ETFs, what's great about them is that as we compound our contributions, as those keep compounding, as the dividends keep getting reinvested, that principal is going to grow beautifully. The number of shares we have is going to grow, and those dividends are going to grow. And the great thing about those is that we can pull out those dividends at some point, start pulling out those dividends at some point as cash, and not even touch the principal. Just let that principal sit there and grow, and those dividends will grow. Even if we're talking $100, $200 a month, that can be significant when you're talking about financing your retirement and being able to do things in your retirement, especially if you move somewhere where the value of the dollar has a little bit more pull. So we're looking overall, our overall portfolio is down into the red, $84.10, but again, long game, it's to be expected. We're just starting out. We're riding that roller coaster. There are going to be ups and downs, but the balance of this portfolio is what's going to get us through. All right. So thank you for joining us again on Retirement Investing Out Loud. If you've got any questions, if you've got some terms that you want clarified, you want me to take a look into, hey, drop that stuff in the comments. I would love to interact with you and love to, hopefully answer some questions on here the next time we get together. All right. So keep investing out loud, everybody. See you next time.